Welcome back, everyone, to Market Wrap. I'm Mo Ansari, president of Compact Asset Management, and you're tuned in as you've been doing so for the last 2 decades now. And as always, you can call in, and I will be more than happy to share with you my 33 years of trading experience. Well, this is the week, the Year in Review, Year in Preview series of broadcasts that we've done all week. Now we are going to be joined by Ken Volpert. Mr. Volpert is a chartered financial analyst. He is a principal senior portfolio manager and head of the Taxable Bond Group at Vanguard, where he oversees management of Vanguard's indexed and active taxable bond funds with assets of more than $180 billion in global investments. Mr. Volpert, welcome back to Market Wrap.
Thank you. Glad to be here.
Let's start with a discussion of the Treasury markets, and this is the bond market year in review, year in preview that we're doing today. And the Treasury markets have seen an unprecedented volatility in the past 12 months. 10-year yields were down to 2.1%, now at close to 3.6. 30 years went down to 2.5. Now they're about 4.5. Where do you think is the future of returns of Treasuries? Do you think the Treasuries are an asset class that can perform well in the medium term for retail investors with about 5 years to retirement? Do you feel that the 10-year bond portfolio offers a reasonable opportunity at the interest rate of 3.6%?
I think right now in the cycle, we've got an economy that's, obviously has a lot of slack in it, and we need a lot of employment growth before we get much in the way of inflation pressure. So I think actually Treasuries with actually corporate spreads performing so well and corporate yields declining so much, Treasuries are actually looking like a more competitive investment than it has in the past. That said, I still think investment-grade corporates will probably outperform it over the course of the next year or so. But in the past, a year ago or so, we were saying Treasuries were probably one of the worst places to be, and it has proven to be that. But looking forward, it doesn't feel that Treasuries will underperform by as much relative to investment grade, but still investment grade corporates would probably be a better place to be investing over the course of the next few years.
So when we're looking at the bond universe, as you're looking at, you think the corporates are going to be better, people are going to be better off in corporates rather than in Treasuries. Last year, Treasuries or this year has been one of the worst performing sectors. Do you think when relatively looking at all of the sectors out there, how will Treasuries stack up compared to everything else?
Probably be the lower performing asset class versus like investment grade corporates or even high yield. I think still has more room to run. It will be a positive. It'll be it won't underperform as much as it has in the past. So for investors who want the safety of the Treasury market, which cost them a lot over the course of the past year because Treasuries were so rich because of the fear that caused Treasury yields to get down so low. The fear isn't there anymore, so Treasury yields have actually risen. There's been what we call a flight away from quality, away from safety, that actually has caused Treasury yields to rise. And I think a lot of that flight is past us at this point. So there's not going to be a lot of additional cheapening of the Treasury market associated with that willingness to take risk.
So if I'm extrapolating from that a little bit, you're expecting the economy to continue to gain strength. You're not expecting any major headwinds for the equity markets, and you think everything will continue to sort of gradually get better, and that's why the Treasuries would be under pressure. So you're not looking for anything like we did last year where everybody ran to Treasuries and we had negative on the 30-day bills, as a matter of fact, at one point. You're not expecting anything like that.
No, last year the market was fearing a kind of a depression, really, in deflation or declining in prices in the economy, and now they're actually they're not pricing in a very rapidly growing economy. I mean, it definitely feels like we're going to have a lot of investors or a lot of America basically saving instead of consuming. We're probably savings rates gone up from close to 0 to about 5%. Which means consumption is dropped by that amount, because if we weren't saving, we're consuming, and so if we're actually consuming less, that's going to be less final demand, a slower growing economy going forward, and with all of the available all the employees, all the slack that we have in this economy, if we have a slowly growing economy, but growing, so we're not going to be in a recession, a very slowly growing economy with still a very productive workforce, probably getting productivity of 3% or so or more, that it feels like it's going to be mostly a jobless recovery with low inflation and very low interest rates and the short-term money market rates for a long period of time. So money will continue to flow into short-term corporates, into short-term treasuries, and kind of out the yield curve. And so investors probably will be better off in those kinds of short and intermediate term investments than they will in money market funds over the course of the next year.
Mr. Volpert, let's quickly go to high-yield bonds. They were up to 21.5% or somewhere around there over treasuries. They have dropped to about 8% plus or minus right now over treasuries. Is there still room? First of all, was that 21% an unrealistic number? It was just so much fear that people just sold everything. And now this 8%, is that still any room left to participate in high yields?
Well, you'll remember that a year ago, the sky was falling.
Right.
The whole market was collapsing. Looked like there was a credit crunch that was going to just bring the economy to a halt, and there was going to be deflation. The TIPS market was pricing in about 12% deflation over 5 years. And so this was a very bad scenario for high yield. Anybody who's highly leveraged in a market where assets are declining in value. It was pretty clear that if that were to happen, that a lot of these high yield companies would go into default because the debt doesn't devalue with the assets. The debt basically stays at whatever the par amount is they need to pay back, but the value of the assets is less. So the high yield market got hit very hard. Well, with all the stimulus that was brought to bear, the fiscal stimulus from Congress, as well as the TARP money, as well as the quantitative easing, all of these really unprecedented kind of initiatives by the government brought really the economy worked counter to the deleveraging that was taking place by the individual investors and by the corporations and by the banks and financial institutions. So with all of that stimulus, actually, it's kind of taken out this Armageddon scenario that was being priced into the market.
Right.
And so looking forward, we do have an economy that's growing, and that's very positive, and it's going to take a while for it to gain any kind of momentum because investors are saving more instead of consuming like we have been in the past. And so I do expect that corporates will continue to perform well, even in the high-yield market. And while a slowly growing economy is not great for the high-yield market, the technicals of the market, meaning that money market funds are going to stay at zero for a longer period of time with a slow growth. And so there's going to be a continual movement of about $3.5 trillion that are sitting in money market funds that will be moving out into other kinds of investments, including the high-yield market and the investment-grade corporate market. And that will continue to cause these sectors to perform well over the course of 2010. So I would expect that those spreads, which right now I show to be about 7 to 7.5% above Treasuries, will probably continue to decline maybe another 100 basis points or even 150 basis points in 2010.
But the easy money from that 21 down to 7.5 has already been made. So now we've got about 1 to 1.5.
In all of the corporate market is behind us. I would say we're more like in the ninth inning, or I wouldn't say the 2-minute drill of the fourth quarter, but we're getting close to the 2-minute drill. Maybe we have 5 minutes left in the fourth quarter, kind of a thing of this recent rally.
Mr. Volpert, I want to thank you for taking the time out. I know you're extremely busy, but taking the time out and sharing your thoughts with us on the bond market, what happened this year, and what we might see next year. From your particular vantage point, it is a unique opportunity to see what you're thinking, because you have a much broader view than most people, I would say, around the world have, and you can see what is going on in the bond market. Thank you again for being with us today on Market Wrap.
My pleasure. Thank you. That
is Mr. Ken Volpert. He is a chartered financial analyst, principal senior portfolio manager, head of Taxable Bond Group at Vanguard. He oversees assets of over $180 billion in bonds. One of the people who really knows the bond market inside and out.